Hey, Deb Meyer here. Let's talk about interest rates. There are a couple of different things to be aware of. First, let's start with a little history. When COVID hit, we were in a lot of economic trouble, and the government pumped lots of money into our economy to try to keep it propped up, right? Then in 2021, we started to see a lot of robust activity going on in real estate, and all kinds of things were very rosy looking as places of business started to reopen. Well, in 2022, the Federal Reserve started increasing the interest rate to combat inflation. The last Fed rate increase was July of 2023. Since then, we've been in a pause, and that's basically meant there have been no rate increases or decreases. All of those interest rate increases that we had before were at pretty high rates from a money market perspective or savings perspective. We're also at a high rate from a mortgage perspective. When I closed on my home earlier this year in May, we were at a 7% interest rate for a 30-year fixed mortgage. And just as a comparison point, in 2020, when we bought our house in Florida, we were at 3.5%. The mortgage rate went up significantly. Well, if the Fed starts cutting rates, which they likely will do as early as next week, we will start to see the tables turn. So the money market accounts, the savings accounts that you've been earning a good interest rate on for your cash, those are likely to move down. Also, the mortgage rates will probably start to come down. If you've been on the sidelines from a housing perspective, this could be a good time to consider purchasing a home if you wanted to get in at a lower interest rate on your mortgage. The other thing I want to talk about is bonds. Bond is basically just a promise to pay. So if you lend your friend $1,000, you expect to get not only the $1,000 back, but also some interest. Well, with interest rates decreasing, the value of bonds actually goes up. It works in an opposite or inverse relationship. Truth be told, if you want to get into bonds more, this could be a good time, especially if they're longer duration bonds or intermediate duration bonds. And duration is basically a fancy term for a measure of maturity, when the bond is coming due or needs to be paid back. It's also a measure of the coupon rate, and there's call options and things like that, but we won't go into that in this video. Hope that's helpful. This is just educational guidance I wanted to give. It's not investment guidance or anything like that.